Hello, this is Stephen Evans, and I'm making a short presentation about the theory and practice behind our investment advice and the model that we use. Investment managers usually use a model which is like a roadmap to show how they plan to get their client, the investor, from their current position to their future goals, which may, for example, be to provide a given level of income in retirement, or to provide for members of the family. But whatever the goals, you do need a roadmap or a model to follow in order to get you there. I'd like to start by showing this chart of the world stock market values. And you can see that the United States is by far the largest stock market in the world, with 54% of values at the end of December 2019. The United Kingdom has shrunk to 5%. 15 years ago, it was 10 or 12%. So there's been quite a change in the world allocation of the investable marketplace. China is now 6% in terms of its investable shareholdings, which international investors can access. So clearly emerging markets, of which China is the largest, are growing in importance. And our approach is to is as a global investor to look at the whole investable universe and allocate our resources across all world markets broadly in line with the size of each market. There is also a very important bond or fixed interest securities market, which forms an important part of any investment portfolio. And the market consists of both governmental fixed interest securities, that's short-term treasuries or longer-term 5, 10, 15, 20-year bonds, where the issuer undertakes to repay the capital at the end of the given period and to pay a rate of interest in the meantime. So it's like a fixed term loan. And both governmental and corporate bond issuers are very important. And this chart represents what are called investment grade bonds, which are the safer end of the market, as opposed to high yielding junk bonds or some emerging market bonds. So we always incorporate bonds within a portfolio to reduce the volatility and the risk and to provide a stabilizer to the shareholdings which are more volatile. This chart over 30 years shows how different asset classes have performed. And if we take an investment in government treasury bills, over 30 years, if you had invested and reinvested the interest income, £1 would become £4 over 30 years. If you had invested in the world stock market, holding perhaps in a fund across all the 12,000 shares across the world stock market, £1 with dividends reinvested would become £13. But it's interesting to note that the smaller companies have produced a higher return over 30 years of £22 compared to £13. Smaller companies are defined as the bottom third of the market in terms of company size. And across the world, the average market value of those companies defined in that way is about £2 billion. So they're not really small companies. Companies such as Rolls-Royce and Standard Life, a lot of what we would call substantial companies would be in the small company category on world scales. Then also we can see that value companies have also outperformed the market substantially. And value companies are those where the share price is relatively low compared to their net asset value. So in other words, they're companies which for one reason or another are currently trading at a cheap value, and by investing systematically in those value companies, the long-term effect is that you can achieve a higher return than the average for the market as a whole. And then you'll also notice that emerging market returns are significantly higher than the average. But again, emerging markets are more volatile, they're more risky. But as part of an overall portfolio, it does make sense to include a proportion of emerging markets. Now, the reason that we hold bonds in the portfolio is demonstrated by this chart, which shows what happened during the financial crisis of 2009 to 2008-9. During that 18-month period, global equities fell by 37%. Property funds fell even more. But the interesting thing is that investment grade bonds rose by 10% and treasuries by 14%. And this is because they were safe haven assets. And if, as an investor, you were already holding these low risk assets, when there is a crisis and investors move into a safe haven, the value of your holding will therefore go up, and it will mitigate the loss that you may have on shareholdings. So we've arrived at a model portfolio, and we're able to simplify it while still getting all the benefits of diversification. So in this particular case, this is what we call a 60-40 equities to bond model portfolio. The bonds are diversified across all world markets, but are investment grade and above. Working with our selected investment partners, Dimensional and Vanguard, both of whom put provision of value for the customer as their top priority. They are by far the lowest cost providers of funds in the marketplace, and the overall fund cost of this model portfolio is 0.32% per annum. So 40% in bonds and 60% in equities, diversified across all world markets, with a weighting towards smaller companies and value companies, and with a appropriate exposure to emerging markets. So this is our roadmap. So we've been able to refine the model and test it and ensure that it provides all of the diversification and other benefits and risk management. And so we will be discussing with you how we would move from your current model to this simplified global model at an appropriate time. And then if we look at the possible outcomes from following this strategy, our investment partners, Vanguard, who are one of the largest asset managers in the world, have a very strong research capability, and they do make a forecast of possible returns from standard portfolios over the next 10 years. So for example, for a 60-40 portfolio, they are saying that the annual return is likely to be in the region of about 4.6% per annum. I mean, there's a range of possible outcomes, but that's the midpoint. As you go up the risk scale with a higher proportion of equities to bonds, that expected return does increase. These returns are lower than in some previous periods, but the good news is that they do expect positive returns from a mix of shares and bonds, and returns above inflation. They would expect inflation to be less than 2% over the coming period. But of course, these are average annual returns, and there will be years when returns are negative and when they're higher than this. So this is an average. It's important to remember that. And then finally, I would just like to underline the risk warning. There is a risk investing in shares. Shares can go down as well as up, particularly in the short term. We advise people on long-term financial planning, and therefore a long-term investment strategy is suitable for that long-term view of building up funds for retirement, building up funds to help the next generation. So as long as you're aware of the medium to long-term nature of the planning, then this can be the right solution for you. Well, thank you very much for listening, and please do let me know if you have any queries. Goodbye.